Hi folks, Kevin Reardon coming to you from Shakespeare Wealth Management. A lot's been happening in the markets, so we wanted to get you some information we thought would be useful. Today we're going to focus on dissecting a financial crisis. We've been through this twice before, and really what we found is the roadmap of a financial crisis, both going through it and coming out of it, regardless of the situation and the crisis, is really the same. So we think you're going to find this to be helpful information. So we're going to go back through history, see what we can learn from that, and then obviously talk about what we can do now to move forward. The presentation's a little bit lengthy, so grab a cup of coffee or a glass of wine, grab a friend, and we hope you find this information useful. All right, so our first slide, we start with a history of the markets. Looking at the bottom left, we start going back to the 1920s, and we invested $1 into small cap stocks shown in the light blue, large cap stocks in the bluish purple, bonds in yellow, in green is money market, and the purple would be inflation. And what you can see, obviously small caps do the best, followed by large caps, followed by bonds, and so on. As you look at various periods in time, you can see at the far left the early part of the graph, the 1930s. You can see the dip in the prices. Ultimately rising through that. You can see in the 1970s a dip. You look in the early 2000s for that dip in 2008. You've probably seen this graph 100 times. At this point, you might be saying to your computer screen, Kevin, can we just not look at this history? We're in the midst of a financial calamity, and this really doesn't apply. So, okay, let's move forward to the next slide. All right, so on this slide, again, a historical slide going back to the 1900s, but this time we're going to look at the market with a more granular lens to see what we can find. And really what we're going to find is that every generation faces its own set of challenges. So if I can have you focus on the 1913 to 1917, obviously World War I, at that point, 20 million people lost their lives during World War I. So really quite a significant event. We as a society moved forward, worked our way forward through that. You can see the 1920s, the booming, roaring 20s, quite, things were fantastic. And then our first timeline, Black Tuesday, that's the start of the stock market crash and the Great Depression. The stock market lost well over 75% of its value. Some numbers here, industrial production for 1929 through 1933 fell 47%. GDP declined 30%. Unemployment more than 20%. 20% of all banks went out of business. So really quite a historic, painful period in our history. Started to grow through that, and then the second timeline, Day of Infamy, obviously Pearl Harbor, 1941, the invasion. We're formally in World War II. Amazing statistics, 75 million people died in World War II, but yet we worked through that, through the 1950s. You can see 1960s, tragically JFK was assassinated. The markets, worked their way through that. The civil rights, the end of the 60s, early 1970s, we had President Nixon was impeached and resigned. 1970s, not a good decade for stocks, a lot of stagflation. You can see 1980s were growing forward until the stock market crash of 1987. The irony is that turned out to be a very quick decline. 1990s, looked real good. And then 2001, we had a terrorist attack, planes flying into buildings, 3,000 Americans died that day, tragically, and the decline that went with it. 2008, 2009, a real estate bubble and credit crisis. So each generation facing their own set of challenges. Here we are in 2020 with a COVID crisis. All right, let's move to the next graph. All right, so we wanted to focus now on modern history and our two most recent major declines. So looking at that yellow circle, we had tech bubble that was brewing through the late 90s and early 2000. That tech bubble started to burst, prices deflated. We got into 2001 and we were having a little bit of a recovery until we obviously had a terrorist attack September of 2001. In 2002, we had accounting scandals with Enron, WorldCom, Arthur Andersen, and really a lot of major firms on Wall Street. During that time frame, the S&P 500 lost 55% of its value and the NASDAQ 70%. So really a dramatic decline. 2008, 2009, you can see that on the graph as well. Not as long, but deep 50% decline there, which we worked through. So modern history, a lot of pain points here. So let's take a look at 2008 because that's the most recent decline. And what I have in front of you is the stock chart, the S&P 500, January of 08 through February of 09. And I wanted just to walk through memory lane with you to see how much we remember. If you can zero in on March 2017, the Federal Reserve intervened to save Bear Stearns. At that point, the U.S. Treasury provided $25 billion of guarantees for Fannie Mae and Freddie Mac mortgage loans. We weren't sure exactly what was going on there or why the Fed stepped in, but we knew something was amiss. Things seemed to recover well. If you look at June and July, the markets were doing okay. July, August, the markets were declining. We get to September 15th, Lehman Brothers, a major New York brokerage firm, declared bankruptcy. September 16th, the Federal Reserve bailed out AIG, a major insurance company, with an $85 billion loan. And at that point, money market funds started to lose assets. $196 billion was pulled out of money market funds, and there was a concern there would be a run on money market assets. September 20th, Secretary Paulson and Federal Reserve Chairman Bernanke sent a bailout to Congress. And then end of September, September 29th, the Senate voted against the bailout bill and they voted it down, sending the global markets really into panic. And you can see October. Finally, by October of 08, the bailout passed. By at that point, the economy had lost 159,000 jobs. The Fed stepped in to prop up banks, and they lent $540 billion to secure money market balances. They stepped in and lowered the federal discount rate to 1%, an absolute historic low point. And by the end of October, the Dow had lost 15% in that month alone. November, the economy lost 240,000 jobs. The AIG bailout grew to $150 billion, and the big three automakers asked the Federal Reserve for a bailout. December, the Fed lowered interest rates finally to zero. The Dow at that point had lost 34%. So we finished 2008 down 34% and really in a tough financial position. From January of 2009 through the end of February, the Dow lost more than 25% during that 2-year time frame. So see if we can test your memory. The pain level at that point was very high. The stock market had lost 50% of its value in less than 15 months. Home values went down. People had lost their jobs. People were on the verge of losing their homes. Do you remember what happened to your 401k? Do you remember what happened to your house value? Do you remember being nervous about your job? As we fast forward, this was the graph we had shown on our previous podcast, and we start in March of 09. And you can see May of 09, GM filed for bankruptcy. Very, very significant event, but yet the market did not dip because of it. In fact, the market simply started marching forward. Remember how you felt and what life was like for you in early to mid 2009. We had just been through a major market decline. Your portfolios were down. Your home value wasn't going up. In fact, in 09 and 2010, home values were still falling. We weren't sure about mortgages. We weren't sure about our jobs, our businesses. Things were tough, but yet the market was moving forward at that point in time. The tail of the tape, this was really the timeline I'd walked you through on the 2008 slide, so you're welcome to go back and read through it if you'd like. So where are we today? And you can see we've had a 30% decline in 22 trading days. That is absolutely the fastest decline in history. Unfortunately, we've made history. You can go back and see below that, 1934, 1931, 1929. The next three fastest declines happened really within a 5-year time frame. So we're in historic times for sure. This looks a little bit more granularly, and we're going back to last Friday, March 20th. As you look at the year-to-date numbers, you can see the S&P was down 28% through last Friday. You can see numbers that were down 35%, 42%, 37%, 43%. The indices near the bottom, those are all international indices. So one of the takeaways is when you have a major market decline, there's really no place to hide. Everything falls in value. Everything except for things like bonds. Those are not on the chart. Bonds have performed very well this year in terms of maintaining their value, which speaks to the importance of diversification and having those conservative asset classes in a portfolio. Last, if you can just focus on the first column, that is the performance of the various indices last week. Virtually all double-digit negative numbers and significant, minus 15%, minus 19%, minus 17%. So the pain point from last week, very significant. This next chart is particularly useful helping to understand market declines. So what we have here is a history going back to the end of World War II, and it talks about various market declines, how many we've had, how deep they've gone, how long it's taken to go down, and how long it's taken to recover. So if I can have you zero in on the second row with a 10 to 20% decline, we've had 27 declines of that amount since 1945. The average decline has been 14%. It's taken an average of 4 months to achieve that decline and an average of 4 months to recover from that decline. The third row, 20 to 40%, is where we are today. We've had 8, really 9 such declines. It's averaged a 27% decline. If you remember, we're down 30% through Monday. Unfortunately, we're above average here in this category. And it's taken an average of 11 months to achieve that 27% decline, and then 14 months on average to get back to even. Those numbers for me are very significant. Instead of 11 months to achieve a 27 or 30% decline, we've done it in 1 month. I think the significance there is that the recovery, if the speed of the decline has been faster, to me that indicates the recovery may be faster as well. And then, by the way, the last column, the number of times we've had a 40% decline or more, 3 times, an average of 51% it's gone down. It's taken an average of 22 months and almost 5 years to recover from that decline. Shakespeare has lived through 5 or 6 of these, certainly 2 of the 3 that have been down more than 40% and several in the 20 to 30% range. This chart, very useful and productive. If I can have you zero in on 2009 and the diamond that you would see here, you'd see a minus 26% number. The diamond represents each year the low point, each and every year, but then the solid bar indicates where the market finished in that given year. So 2009, we were down 26% in February, but we finished the year plus 26%. That's a 52% change, peak to trough, in the same year. Really substantial. 2010, down 16% at the low, but we finished plus 15. 2011, down 17, we finished plus 2. And so we have down components of every year. That's not to say that's where we'll finish. Now, at this juncture through yesterday, we were down 30%. I'm not saying we're going to be positive for the year. It's possible. The takeaway is it's very probable we'll be higher than minus 30 by the time we get to December. But this time it's different, right? The reality is the market responds to a crisis the same way, time after time after time. As you zero in on these graphs, when you see blue, that denotes a 1-year time frame. When you see yellow, that's a 3-year time frame. And when you see green, it's a 5-year time frame. The first scenario looks at the stock market crash of 1987. 1 year after the fact, the market was positive 21%. 3 years later, 37%. 5 years later, 61%. If I can have you go towards the right end of the screen, the terrorist attack of 2001. 1 year later, we were negative 3%. 3 years later, plus 42%. 5 years later, plus 84%. And then the most recent decline in the market, September of 08, you can see the 1 year, 3 year, 5 year numbers all positive. Every market decline is caused by something new and unique, but the market's response is the same. The market grows through a crisis. On the screen in front of you lists the worst trading days starting at the top, and this graph unfortunately is outdated because we've had some record-breaking days since this was put together. But the takeaway, you can see at the top on the left, 2008, December of 08, September of 08. As we move to the right, this lists the best trading days in any given year. And you'll see the first days, 2008, 2008, 2009. The best trading days happen subsequent to the worst trading days. One of the major takeaways from today, and we're seeing it today literally in the market, Tuesday, March 24th, a very strong day in the market following really a really awful week last week. So you have to stay invested around these downturns because the quick money, the easy money happens immediately following these declines. In front of you is the investment cycle, and I call it the cycle of emotion. This graph is really important, and I want to spend some time on it. As the markets are going up, starting on the left, people sense optimism, they sense excitement, thrill, ultimately euphoria. Go back to the late 1990s. We were in the heart of the technology revolution. New companies were coming out with new products. Companies were getting more productive. Corporate earnings were going up. Everybody was making money. And then things started to roll over. We had the technology bubble burst with prices falling. We had a terrorist attack. There was denial and fear. Then we had accounting scandals with Enron and WorldCom. There was panic, ultimately capitulation, despondency, and then a bottom. Look at today's market. If we go back to 2019, really strong prices. We were excited. We were thrilled. I wouldn't say we were euphoric, but I would say that we were much more confident in how we were spending money at the end of 2019 relative to the last 10 years. And then as we entered 2020, we started to hear some things about a virus in China. And then we heard that that virus had hit the United States. And then there was a ban on travel. And then schools were canceled. And then there were stay-at-home orders and social distancing and businesses closing. We're at this capitulation despondency point as far as I'm concerned based on the market and based on talking to a whole lot of people. Ironically, this is the point of maximum opportunity when you feel maximum pain. Eventually, by the way, there'll be hope. The market will tick higher. We'll get through this COVID issue. There'll be relief. Ultimately, there'll be optimism. So here are the key components of a major market decline. First, there's the reality. Bad stuff has happened, folks, right? I'm not all unicorns and rainbows. There's some bad things that have happened. Then there's fear plus reality is that bad stuff is going to keep happening. The economic numbers will get worse. The COVID numbers will get worse. Then we go to projection. People are saying we were down 15% last week. We will be down 15% this week. And at this rate, we're going to be out of money in a month. That's what's known as projection, where you're taking the last few weeks or the last few months and projecting that forward. From that comes hoarding and self-preservation. We've seen the hoarding, right? The toilet paper stories and things like that. The self-preservation is, Kevin, why don't we just put some money on the side? I just want to protect what I have left. So it's that self-preservation mentality. Media is a huge component of a major decline. They get paid to magnify the news. The media is not our friend during these times of calamity and concern. What the media does at these times is they search out experts and they put a microphone in their face. Those experts are dangerous from my perspective. From 2000 to 2002, what we learned was the self-dealing that went on. The brokerage firms that were putting buy ratings on investment reports for various companies, but then around the back end, we're trying to earn the investment banking business for those same companies. And while they were doing both of those things, putting buy recommendations and getting the investment banking business, they were potentially selling their securities, that stock, out of portfolios. So a lot of self-dealings. The conflicts of interest, when you see the mutual fund manager or the hedge fund manager on CNBC and he's saying the sky is falling, understand that hedge fund manager is out in the marketplace at this juncture buying stock at low prices. He is in essence trying to push the market down to profit. You might think that's ridiculous. It happens all of the time. And then legal constraints. If you asked a health expert what they think at this juncture, they absolutely can't say this is no big deal. Legally, they can't say that. And so as you're taking feedback from the experts, understand these three components that are impacting what they're saying. Another key component of a major decline is the unknown. The market absolutely wants certainty, and when it can't get it, it falls in value. From our standpoint, I can show you all the charts in the world. What I hear back is, yeah, but the numbers are going to get worse. That's correct. Yeah, but the COVID numbers are going to go up. That's correct. Then why are you wanting to stay the course? Show me the proof. And the reality is there isn't any proof. And let me come back to that point in the next slide. The last component of a major decline are opportunity seekers. We have the Warren Buffetts of the world, and then we have the average investor, the doubters. The Warren Buffetts of the world step up in this marketplace and they swing the bat, they buy the stocks on the cheap. The average investor stays on the sidelines. So the stock market versus the economy, if you were to tell a friend to look at one chart of this whole presentation, this is it. Markets are leading indicators. They will lead us higher before a solution is presented. If you're waiting for an indicator to invest, you are too late. You're asking for indicators. I can't give them to you. The reality is they don't exist, but the market will move higher. Economic numbers are lagging. Yes, the economy numbers are going to get worse. The COVID numbers are going to get worse. That doesn't mean the market can't and won't go higher. Eventually, there's news saturation. At a certain point, the market stops listening and just moves forward, period. And I can't explain it. It's just the way it is. Understand your decision factors. What is your time frame? What is your cash flow? What's your tolerance? For my retired clients, your time frame isn't 0 and it's not 1 or 2 years. Frequently, it's measured in decades still. And so, take that into account, and we've taken it into account as we're building portfolios. The greatest investment mistakes happen with I feel and I think. The most humbling experience for me as a professional investor is to realize that the market doesn't care what I feel. The market does not care what I think. It doesn't, folks. And so as I show all those graphs to you in the past, what I hear is, this is great, but I think and I feel. I do care what you think and I do care what you feel, but the market doesn't. It absolutely doesn't. If you're using these two words to make investment decisions, you're gonna lose. And this time it's different. It's really not. It's absolutely not. The trigger point's different for sure, but the market's reaction to volatility, to unknown, it's the same time after time after time. And so the solution, discipline, and that's what we deploy through portfolios. Discipline, discipline, discipline. When will we get the turnaround and what will be the trigger point? You can gauge from the last graph. I don't know. I can't point to it. I know it's going to happen. I don't know when, how quickly, but it will happen. So there are a lot of positives to consider at this point. First and foremost, the healthy economy pre-virus. We can talk about how strong it was or wasn't. The reality is it was healthy. Corporate cash positions. Look at these numbers. Microsoft has $136 billion inside their company. Warren Buffett's company, $128 billion. Google, $121 billion. Apple, Facebook, $52 billion. The question is, when stock prices are depressed, Ford, $37 billion. What will these companies do? We know Warren Buffett is out there in the marketplace buying today. The stock market decline has been quick and deep. That's a good thing. That means we can recover faster. Global infrastructure is intact. Oil, interest rate, inventories are low. The banking system's strong. Global fiscal and monetary stimulus all over the globe. The COVID controls are aggressive. We can discuss timing and implementation and is it enough? The reality is schools are closed, airlines are virtually shut down, businesses are virtually shut down. We're not watching a ball game, things like that. The controls have been aggressive. Healthcare system has really suspended non-elective procedures. Typically a hospital runs at 90 to 105% capacity. A lot of hospitals are at 75% capacity because they've deferred the non-elective procedures. Yes, there's resources that are in short supply, like ventilators and things like that. But in general, the healthcare system is preparing as best they can. The first movements higher will be quick and significant. Today, we had more than a 5% movement higher. And this last positive may sound strange, but the pain level is high right now. That's a positive. That tells me we're very close to a bottom. So here's what you can do now. First, cash flow. We've always preached that you keep 3 to 6 months of living expenses in the bank. Review what you have now. Review your budget. What are your non-essentials in that budget? What can you cut out? Rebalance your portfolio. If you had 70% in stocks in January, you're likely down to 55% today. Go through your 401k, rebalance. Look at refinancing your mortgage. Roth conversions make sense because we have low market values and historically low tax rates. But before you do this, give us a call. We're actively realizing losses in your taxable portfolios. Fund long-term savings accounts, 401ks, IRAs, and things like that. If you're in withdrawal mode, in February, we made sales. We took money out of your portfolio. We put it in money market in anticipation of your withdrawals in 2020. So we've prepared this already on your behalf. Consider alternative sources, line of credit, cash value life insurance, or even margining on a brokerage account. And last, turn off the COVID shot clock. If you're looking at it on an hourly basis, it's likely too much. And last, here's some sizzle, okay? We don't own individual stocks, but I wanted to provide some perspective. And one of the takeaway points is that at a certain point, investors step in regardless of the news and they buy stocks. What I have in front of you is General Electric, top left. In dark blue and in light blue is the S&P 500. On the far bottom right, you'll see General Electric down 45% this year. My question, GE's a $7 stock. At what point does Warren Buffett want to buy GE? Striving for more perspective. This next graph looks at GE again, but it's a 5-year history. Upper middle, you'll see the 5-year number. General Electric was a $30 stock a few years ago. So we can debate whether GE is a well-run company or a poorly run company. The reality is at $6 a share or $7 a share or $4 a share, at a certain point, investors start buying these companies. One more, Citigroup. Okay, one of the largest banks in the world in dark blue. The light blue is comparing it to the stock market. Bottom right, you'll see Citigroup down 55% this year. What has changed for Citigroup in the last month? A lot. I mean, no doubt, a lot's changed in the world in a month. Does this stock deserve to be down 55% this year? One more perspective, folks. Here's Citigroup again, but we go back 5 years, a little bit more than 5 years actually. Go back 12 years. You can see Citigroup on the far right, follow that up. Citigroup was a $500 stock at one point in 2008. Today, it's in the upper 30s to low 40s. So from 500 to 40. At what price do you think a hedge fund manager or Warren Buffett will want to buy Citigroup? So it really speaks to the valuations and the opportunities that are out there in the marketplace today. So what's next? Again, the economy is going to get worse. The COVID numbers will grow. Those things are disconnected from the market. The market is looking forward. And what the market eventually says is, I don't care about the next bad news story. The opportunities are worth more than the downside of that next bad news story. What information would you like to hear about? Please let me know. This certainly is quite a lengthy video cast. My apologies for that. I'm considering the next video cast to be about COVID by the numbers. Still debating that, so let me know if you think that's worthwhile. Kevin Reardon from Shakespeare Wealth Management. If you have questions, certainly give us a call. Our contact information is there on the bottom, and I hope you found this to be beneficial. Thanks.